Let me start off the video by telling you the fate of 4 most recent and popular IPOs. The first IPO was Coinbase. Coinbase got listed at an IPO price of $340 in 2021. However, today, in 2023, the stock price of Coinbase is only $80. The second company is Robinhood. Robinhood's IPO price was about $35. However, today in 2023, it is only trading at about $10. The third company on the list is Coursera. Coursera got listed for about $45 in 2021, and today in 2023, its price is only about $18. The fourth company on the list is Uber. Uber in 2019 got listed at about $41. However, after 4 years, in 2023, the stock price is still around $45, which means you would have not made significant amount of money by investing in Uber's IPO. What you see is a common theme across most of these IPOs. That is, they got listed at a very high valuation. However, within a short span, the stock fizzled out, causing a loss to the public investor. In this video, I will tell you the fundamental reasons why you must exercise caution when investing in an IPOs and why investing in IPOs might not be in your best interest. My name is Kanak and welcome back to my channel. Subscribe to my channel for interesting content from the world of finance, investing and economics. Let me start by explaining you what an IPO is through a very simple example. Imagine you have a restaurant business that you want to sell. In order to sell the restaurant business, you hire a broker whom you pay about 7% commission of the sale price. As you can see, it is in your and the broker's interest to sell the restaurant business at the highest possible price to generate the maximum possible commission and profits. The broker would try to market the positive aspects of the business and also try to time the selling of the business when you can get the best price for it. This practice could potentially result in the business being sold at a valuation that is significantly higher than what it is actually worth it. While this may be good for you and the broker to sell the business way above its actual worth, it could potentially cause a loss to the investor who's buying your business. But unfortunately, this is a very common theme observed across a lot of IPO listings on the stock market. Before I tell you why investing in IPOs might not be the best decision for you, let me explain you the incentive structure of IPOs. When a company decides to go public, which means when they decide to sell their shares to the public investor, they hire an underwriting company such as Goldman Sachs, JP Morgan and so on. The job of the investment bank is to market the company to investors and to sell the shares to public as well as institutional investors. Now there are two ways in which the investment banks get paid. The first model is a flat fee commission, where the investment bank gets a fixed commission on every share that they sell. The second model is where the company sells a fixed amount of shares at a predetermined price to the investment bank. Now, in order to generate profit, it is the job of the investment bank to sell these shares to the public investors at a price higher than what they paid to the founders of the business. As you can see, the investment bank has the highest incentive to sell the shares at the highest possible price in order to generate its commission as well as profit. Now, in order to sell these stocks at the highest possible price, the investment banks heavily market the company to the investors and decide the time of launch in order to maximize the sale price of the stocks. Usually the investment banks will launch the IPO at the peak of the market boom, because that's when they will get the highest price for the stock. And not only that, but the investment banks would also try to create a hype around the stock. This practice could potentially result in overvaluation of the stock. While this may be good for the investment bank and the original investors of the company, it is stacked up against the public investor. Now let us talk about the 4 drawbacks of investing in an IPO. The first and the biggest drawback of investing in an IPO is overvaluation. Due to the hype created around the IPO and the timing of the launch, for most part, IPOs are usually significantly overvalued than the actual worth of the stock. And if you're a long-term investor, then this might not be the right choice of investment for you. The second drawback of investing in an IPO company is lack of track record of operating in public domain. Publicly listed companies are regulated by SECs and have to submit their financials every quarter. However, IPO companies do not have a history of operating under the regulations of SEC and also to operate in the public domains. And not only that, but it is difficult to get details about the company as an individual investor. There is a lack of history of coverage of IPO companies from various investment firms. The third drawback is a myth that IPO companies have strong financials. To be listed on the stock market, a company does not necessarily have to be profitable. However, the financials have to be audited and should accurately represent the financial condition of the company. The fourth drawback of investing in an IPO is timing. The timing of launch of an IPO is stacked up against individual investors. The investment banks decide the time when they can get the best price for the sale of their shares, and usually this is when the market is at its peak. So for long-term investors, investing in an IPO at the time of its launch is usually not a favorable deal. So what is the right time to invest in an IPO? Usually the insiders have a lock-in period of 3 to 24 months before which they cannot sell their shares in the public market. So it is advisable for individual investors to wait until the lock-in period ends and to observe the behavior of the insiders. If at the end of the lock-in period, if the insiders decide to sell their shares at the available spot price, it is an indication that the stock price is overvalued. So, in summary, investing in an IPO could potentially result in investing in an overvalued stock at the peak of the market in a company that lacks track record of operating in public domain and a company which might not have strong financials. So, it is important to be very cautious when investing in an IPO.